Welcome to this explainer breaking down Covenant Logistics Group's Q2 2026 earnings. Honestly, this is a fascinating case study. We're looking at a wild tug of war right now between a brilliant strategic pivot on one hand and brutal operational pressures on the other. It's a classic scenario of what happens when your top-line strategy works perfectly, but the bottom-line reality fiercely fights back. CEO David R. Parker actually nailed this paradox right out of the gate. He said, "We made constructive changes on the revenue side of the business, but our costs disappointed us." Honestly, that one sentence tells the entire story of this quarter. Constructive revenue changes, but deeply disappointing costs. Let's dive into exactly what he means by that.
So here's how we're going to unpack this tension. We'll hit the Q2 financial results, look at their strategic fleet pivot, dive into those costs and margin headwinds, check out managed freight, and finally, scope out the road ahead. All right, kicking things off with Q2 financial results and that top-line performance. Starting from the top down, total revenue came in really strong for the quarter at $332.8 million. That is a very solid bump from Q2 of 2025, which was sitting at around $302.8 million. So money coming in the door, definitely growing. But as we all know, bringing in more cash doesn't automatically translate to higher profits. If you look closely at their operating income compared to that total revenue, you'll see that while the top line grew beautifully by about $30 million, operating income actually dropped from $11.5 million down to $8.8 million. It's that classic margin squeeze. It's kind of like a game of financial whack-a-mole, right? The revenue popped up in the front door, but the operational costs bolted straight out the back. Moving on to part two, the strategic fleet pivot, where it's all about quality over quantity. So why did revenue jump in the first place? Well, it really comes down to a deliberate pruning of their fleet. Covenant made some incredibly surgical moves this quarter. They shrunk their overall fleet size by 3.3%. On top of that, they shifted 15% of their expedited fleet away from uncommitted freight, locking them into much more attractive committed contracts. They also leaned heavily into stable, dedicated contracts, specifically expanding their ag protein supply chain. And maybe the biggest move? They simply implemented rate increases and dropped unprofitable customers who just weren't hitting their margin requirements. What we're looking at here is fundamentally a tale of two segments. On one hand, you've got the expedited segment. Historically, this is high mileage, capital intensive, and heavily reliant on volatile, uncommitted freight. They are purposefully shrinking that down. On the other hand, you have the dedicated segment, specialized, highly predictable, and operating on committed multi-year contracts. They are aggressively growing this side. Basically, they're trading wild volume for predictable stability. And when you dig into the underlying operating data, it reveals one massive, undeniable win for the strategy. The strategy worked exactly as planned. Their combined truckload average freight revenue per total mile shot up by a massive 15.1%. By pruning out the bad freight and focusing intensely on high-quality contracts, every single mile they drive is now worth significantly more. It is a textbook execution of prioritizing quality. Which brings us to Section 3, Cost and Margin Headwinds, or as I like to call it, the reality of operations. Now you're probably wondering, if the revenue strategy works so beautifully, why didn't margins expand? Well, because their operating costs jumped 16% per total mile. Yeah, you heard that right. They earned 15% more per mile, but it cost them 16% more to drive it. Some of this was general overhead that hasn't shrunk quite as fast as their tractor count over the last year, but the real pain came from massive, totally unexpected spikes in maintenance and insurance. And this is the crucial point to take away. Combined maintenance and insurance claims alone surged way beyond their historical averages. We're talking roughly 8 cents per diluted share more than they expected, just for those two line items. That completely wiped out the gains they made from their higher-paying freight. For those of you tracking freight cycles for your own logistics planning, this is the big lesson. No amount of high-paying freight can outrun a brutal, unexpected spike in maintenance and insurance. Plus, we all know about the looming threat of nuclear verdicts in the trucking industry. Covenant explicitly cited this ongoing unpredictability as a huge reason why insurance expenses are basically impossible to forecast right now. These exceptionally high jury awards are making risk retention incredibly expensive, and it's eating right into the bottom line despite all of the company's best safety efforts. All right, on to Section 4, Managed Freight and Early Cycle Margin Compression. This tension between rising revenue and rising costs, it isn't just happening on the asset-heavy side. If we look over at managed freight, top-line revenue actually grew by an impressive 28.4% year over year. But much like the trucking side, they got hit with early cycle margin compression. They are caught right in the middle right now, paying spot market prices to secure carriers while their customer revenue is locked in at lower contractual rates. Finding quality carriers is getting tougher and more expensive, so those capacity costs are rising way faster than their revenue per load. And compounding this margin squeeze is a pretty serious legal factor. The company explicitly warns about the threat of the Supreme Court's recent Montgomery decision. They're highlighting this ruling as a dangerous expansion of liability, specifically for managed freight operations, threatening to make their insurance issues even more costly and complex down the road.
Finally, Section 5, the road ahead, outlook, and expectations.
So, the ultimate question, will Covenant's strategic pruning eventually outrun these brutal operational pressures? Here's how they see it playing out. For Q3 of 2026, they are expecting a modest sequential increase in earnings per share as margins slightly improve. But the real transformation happens over the next 12 months. Roughly 40% of their expedited fleet and 25% of their dedicated fleet are on contracts renewing in the coming year, and many of these are their absolute least profitable ones. As those renew, Covenant expects their fleet size to stabilize and margins to gradually and materially expand over the long term.
It is super clear they are playing the long game here. CEO David R. Parker noted, "We intend to patiently pursue the customers and markets that help us create sustainable long-term value." They are fully willing to take a short-term margin hit to build a rock-solid, less volatile base of multi-year contracts. They want to be almost entirely undercommitted contracts by the time we hit the end of this freight market upcycle. But as we wrap up this explainer, I have to leave you with this question. Will Covenant's aggressive push for committed contracts be a strong enough shield against the industry's persistently rising costs? The strategy is absolutely sound, but the operational realities out there are ruthless. Keep a close eye on this dynamic as the broader freight cycle unfolds. Thanks for exploring this with us.